Hello there, everybody, and welcome into tonight's session. So tonight, what to expect from markets in 2022, I should say. So we're wrapping things up for the year, guys. Okay, we're less than a week away from Christmas now. Oh, it's been such a big year, hasn't it? Right. So lots going on between COVID and different central bank action and the rest of it. Been pretty sort of steady market, I guess, over the last 6 months. Not a lot going on in our local market, probably a bit more in the US markets. And that's kind of the purpose of tonight, right? So, what we want to do is just run through, cap off the year, have a chat of what we expect to come into next year in the way of markets, and show you through a little bit what we're interested in, a few of the themes and the sectors that we're going to be looking at very closely in 2022. So I'll get started. Yep, 7:01. I can see most of the numbers have settled down in the way of people logging on. So let's get stuck into it. Before I go any further, I have to say that any advice contained in this presentation is general only. It doesn't consider your personal circumstances, objective or situations or needs. And you should consider whether it's appropriate for you. The information we are giving you tonight is for educational purposes only. Okay, so a little bit about who we are, if you don't know already. Okay, we run two main brands. One is Emerald Financial, and one is Trader Circle. Trader Circle's been around for it's got to be 18 odd years now. That's where we all started. Okay, we started Trader Circle to help support traders. Okay, so more short-term trading using derivatives as the main focus, and we do a lot of education and training programs on how to use derivatives to trade short-term movements in the market. We're one of the busier options trading desks in Australia, and yeah, so that's been the main business drive for a long, long time. Emerald Financial came about 3 years ago, just a little bit before the pandemic started, and that was born from the advisors from Trader Circle. So we still all work for Trader Circle. We still do our daily trading desk, but we've adapted that, brought on a few extra resources, and also run Emerald. And Emerald's more around research. So, and they fit side by side perfectly. So, a lot of the research we do in Emerald, even though it's more long term based, it does help us with trading ideas. Okay, so we've expanded the business out, and in Emerald Financial, we do research. We do more of the long-term investment advice. We've designed some stock screeners, as well as within that, our own unique quantitative scoring system. Okay, which helps us screen through the markets here and in the US to find the better performing stocks. Okay, so portfolios. We've got a various different ETF portfolios you can look at as well, and of course execution services. Okay, so with us, I think the big thing with Emerald Equities now and Emerald Financial is that we've got a pretty big focus offshore. Okay, so yes, we do a lot of Australian equity recommendations and things like that. But really, if you go have a look at the US markets at the moment, they've been way outperforming the Aussie. And we're finding that we're slowly starting to get a lot more ideas coming out of the US markets. So, we're not just Australian focused, we're heavily US, and we will be looking towards other markets around the world pretty quickly as well next year. So that's who we are. That's our goals. That's what we're looking at. And we've got two clear brands. One's for the more shorter term focused trader, okay, and one's more for that longer term investor. That's obviously trying to set up a portfolio, looking to outperform the market a little bit, and look more for that long term opportunity. So tonight, just a little bit about who's talking. So I'm going to be joined by Sam Green. Okay, I've been working with Sam for it's got to be 9 years now. We both started at Trader Circle at a very similar time. He is our equities analyst. Okay, he does a lot more of the longer term analytical work on our recommendations before we put them out. He knows so much about markets, guys. It's not funny. The brilliant thing here is we're very good with the short term, being short term traders with Trader Circle. Now bringing in the fundamental side, what we're finding is we're able to really finesse the timing of things. And Sam's great at doing that. Okay. He's a good analyst, but he's also very good at timing when to get into the market as well. So he's going to actually be talking a lot tonight. He'll be taking most of the next half an hour to have a chat about what we expect coming into 2022 and his view economically, as well as his view what's happening in the marketplace. So for me, as I said before, I've been with the business for 10 years. I basically run the trading desk and general manager across the two brands as well. Also, I am an advisor myself. I have a group of clients that I work with very closely with various different options and equity strategies. So, doing still quite a bit of advisory work as well. Okay, so that's enough about that. Without any further ado, I will give you over to Sam Green. He's going to have a good chat about what's to come next year, and I'll come back on a little bit later just to run through our trading services a little bit and have a chat about how we use the Emerald Equities services, screeners, and things like that to find opportunities here and in the US. So I'll come back to you guys after Sammy. So I'll hand you across to Sam now.
Cool. All right. Well, thank you very much for that lovely introduction, Tim. And yeah, hello to everyone online. It's great to see all of you jump on, especially at this time of year. You know, it is a time of year when everything is sort of wrapping up a bit and everyone's got other commitments. So yeah, thanks so much for giving us your time this evening. And yeah, hopefully you enjoy our session. Hopefully you find something interesting or find something of value. Also, hopefully you can see my screen. I should be sharing it with you now. And yeah, basically I'm going to run through, you know, a little bit of what's happened in 2021 and also, you know, what we expect going on into 2022. All right, so let's get into it. So if we actually look back at 2021 in equity markets, it was really the year of recovery. I mean, a lot of markets did start recovering in 2020. But 2021 was when most markets around the world, or at least most major equity markets, returned to their pre-COVID levels. So this is a helpful chart from the RBA, and they used Bloomberg data. And we can see over here, this is basically just before the virus selling began, January 2020. And yeah, as of now, in late 2021, the majority of markets are back above that pre-COVID level. We can see that the UK has still lagged somewhat. They're not quite back to their pre-COVID levels, but they've obviously had other political and economic issues, you know, that have influenced their markets movement. There is one standout performer, however, and that is the US market. We're going to touch on that in a little bit, but if we actually look at, you know, the US market more specifically and compare it to our own, we can basically see that, yeah, the US market has strongly outperformed our market for the past 12 months. And, you know, even before that, it was outperforming since the bottom of the selling for the virus period. So the dark blue line here is the US market, the S&P 500 index, their largest share index. And this bottom line here is the Australian market, which is our top 200 share index. And yeah, over the course of this year, we have rallied about 10%. Obviously nothing in comparison to US stocks, but still a respectable amount, you know, given that there's been plenty of uncertainty, plenty of domestic lockdowns here in Australia. You know, our two most industrious, our two most important economic regions have been shut down for a large amount of this year. That sort of thing does impact, you know, economic outcomes, and it does end up impacting stock markets. All right. So if we actually look at the performance of markets around the world, and I've stolen this from our morning report, so we actually put this out every day, but over the past year, the average global stock has essentially rallied 20% in 12 months, which is quite incredible given the virus period that we've seen. I'm sorry, Ian's not getting any picture. Hopefully you guys can actually see the image that I'm presenting.
Yeah,
Yeah,
I can see you from my side, Sam.
Mhm.
So if you're not seeing the image, guys, just quickly jump out and come straight back in. This has happened once before, and I apologize about that. But yeah, just jump straight out and come straight back in. It should fix itself.
Thank you, Tim. And yeah, apologies if you have dropped a picture there, but yeah, the average stock we can see over the past 12 months or past year, it's up 20%. And really that is almost entirely led by US shares. US shares are up around 30% over that time, and they make up such a large proportion of the world's equity markets that their outperformance means that the global average performance looks extremely strong. In comparison, our own market is a bit over 10% higher. The European markets, between 10 and 20% higher. And the Asian markets have actually underperformed extremely strongly during this period. So we can see that the main Asian markets here, the Nikkei, the Hang Seng, the Shanghai Composite, really have underperformed all the Western markets. In the case of, the Hang Seng and, arguably the Shanghai Composite, there have been political issues, there have been economic issues that have sort of held them back a bit. Um, there is a lot of talk about whether, that's going to reverse in 2022, whether, the selling, a lot of it's being caused by Chinese government intervention in, their outwardly facing companies, especially their technology companies. There's a lot of talk about whether that's going to reverse in 2022. And to be honest, it's almost impossible to say. You're trying to predict the behaviors of a few individuals who are notoriously unpredictable. Um, that being said, the stocks there are quite cheap. The stocks, the growth rates they get, the sectors that they're in, they trade at a much greater discount to you know international shares than anywhere else on earth because of that risk. So there is a lot of opportunity, but a lot of risk in the Asian markets, particularly the Chinese markets, moving forwards. All right. So what else did we see in 2021? Well, we saw a big lift in pretty much all commodity prices. We can see in oil prices, top right here, coal, LNG prices over here on the left, base metals prices, coke and coal prices. Most commodity prices actually, at least, metals and energy commodities rallied extremely strongly in 2021. And that's actually a really positive sign for the world economy. You assume that when there's a lot of demand for these products, that will influence pricing. And also, maybe when there's a bit of a drop in supply, that could also create a lift in pricing. And what I will say is that some of these commodities have seen some supply come off, but supply for a lot of them has been fairly consistent. And so it is, in some cases, a demand story that these prices are going up. Container shipping is a little bit different, and that's something that is starting to be discussed around the world. The cost of shipping overseas is extremely high at the moment, and is likely to remain high for a while yet. There's a few reasons for this, but basically it's essentially because there was a big jump in consumer demand for shipped goods during the coronavirus lockdowns. And at the same time, you were having, struggles with labor at dockyards and things around the world. So, in the US, for example, which has very large and important ports, they couldn't get the amount of staff they needed all throughout the year at the shipping yards, and it led to build-ups, led to increased costs. So, for example, in late October at the Los Angeles Long Beach port, ships were taking twice as long to turn around than they were before the pandemic. So if you couple that, impact to labor with, a big jump in people taking delivered goods, as opposed to going out and buying things locally, it's caused a big jump in the price of shipping, and that has influenced the price of a lot of goods, and it is potentially impacting, all this talk of inflation, all these lift in prices that we're seeing in, particularly in Western consumer goods prices. So, what happens when we see big lifts in prices, or what happens when we see inflation? Well, we get talk of monetary policy tightening. So, in the US, they had extremely expansionary monetary policy settings. Not only did they lower, the overnight funding rate to zero, or the official interest rate to zero, but they also went into the bond market and started buying up US government bonds in a process known as quantitative easing. The reason that they do this is to push the price of those bonds up. And effectively, when those bonds are high in price, that means that they yield very little. So by doing quantitative easing, they're actually pushing the yield curve down. These lines are yield curves, and we can see this green line 1 year ago. That was the U.S. government bond yield curve, and essentially, it's saying bond prices are very, very high, bond yields are extremely low. Don't invest in bonds. Go out and invest in riskier endeavors. Go and do lots of spending. The cost of borrowing should be very, very low, and trying to generate economic activity. The problem with that is you can generate an overheating of economic activity, which can cause prices to rise, out of control. And that's the story about inflation that we've been hearing for, much of the past 12 months. So with everyone worried about prices overheating and getting out of control, they have to reverse those settings. They have to start lifting the yield curve back up again. They have to start eventually thinking about lifting interest rates. And so over the past 12 months, the US government bond yield curve has lifted higher. So we can see the dark blue line is the current yield curve. And in 12 months' time, it's really shifted quite notably higher. Shifted quite notably higher. And much of those shifts have occurred in the sort of near-term parts of the curve. You actually look at this lighter blue line, which is actually from a month ago, you can see that the expectations for longer-term yields have actually dropped in the past month, while they've actually lifted for the shorter-term yields. Now, the reason for that is actually a bit of a negative one for the market. The market is saying that we think this overheating story is going to die out a bit, in 3 or 4 years' time. And they're probably right. They are probably right, and we'll touch on that in a minute. But the Federal Reserve, which is the U.S. monetary policy apparatus, they also agree with the bond market. All right. So the reason they're starting to talk about lifting interest rates, starting to taper their bond buying, is because of inflation. Now, usually you would, start tightening monetary policy to deal with demand side inflation. It's just basically too much money being spent, you know, uh, too much domestic economic activity. Things are running too hot. But if you actually look at the numbers of where the price increases have come from, it's not really demand side at all. In fact, largely it's due to either supply shortages or base effects. For example, if we look at US inflation data for October and November, the largest gains in price came from energy. Energy prices like fuel, gas, oil, heating oil, energy services. And you can see that in these darker squares here. So the biggest jump was actually from a base effect of prices being, for oil and energy and fuel prices being a lot lower earlier. The other things you can see that jumped quite heavily were things like used cars and new vehicles. And that was because there was a large shortage of these things. It was difficult and expensive to transfer them via shipping because shipping was becoming really expensive. And there were very few of them being made because there were supply gluts in some of the key supply markets for vehicles. So actually, when you look at the numbers for US inflation, we believe, and I think to some degree, the bond market is starting to believe that everyone got too far ahead of themselves, taking this view that inflation was running out of control because, of strong overheating economic demand, when in actual fact, it was mostly due to base effects and supply gluttages. So trying to treat, supply side factors with a tighter monetary policy might not be the best idea. But that's something that we're going to have to keep in mind going into 2022, because at the moment, definitely we're seeing a tightening of monetary policy continue. Here in Australia, it's the exact same thing. So this is the Australian government bond yield curve. You can see that a year ago, our yield curve was, fairly low, and you can see that basically we've started pushing our yield curve higher as well. So these blue lines are, the current yield curves, the light blue being 1 month ago, and the darker blue being the current Australian government bond yield curve. Again, people are taking the view that our RBA is going to have to lift interest rates. They're going to have to stop their own bond buying, and that's because of, supposed runaway prices. Here in Australia, our inflation rate is actually, inside the RBA's target range. So it is, again, I think, that the bond market got a little bit ahead of itself when it was pushing these yield curves up. And as a result, we have actually seen it come back a bit over the past month. So you can see that the current yield curve has dropped, particularly the longer sort of maturities here in Australia across the past month. And I think, again, the market realizing that it got a bit of ahead of itself with the inflation story. All right. This is the RBA's forecast for inflation. And really, the inflation and bond rates and lending rates are one of the most important determinants of what our market's going to do from here, what our equity market's going to do. You can see that basically the RBA has an extremely wide range of what they believe inflation is going to be. It could be as high as, a bit over 3%, could be as low as a bit under 2%. These things are notoriously difficult to forecast in the long term. And I will say as well that unfortunately the RBA doesn't have the best track record of forecasting, things like inflation moving forwards. Regardless, though, this is actually roughly their target range, 2 to 3%. So, that it is back in this range is probably a positive as they see it. And also, it's not beyond that range. So, the market taking a view that we're having an overheating just because the US inflation rates are high. Again, the market perhaps getting a bit ahead of itself. And no surprise, across maybe the past month or so, we've seen those yields here in Australia start to come down. So, what does the RBA view growth as doing in the next 12 months? Well, they think we're actually going to see a significant period of outperformance. So, across the next 12 months, they think we're going to grow at around 5%, GDP growth of around 5%. They do think that the current quarter, the December quarter, will actually drop off a little bit before we, witness across calendar year 2022, 5% growth. Um, Essentially, after that initial period of outperformance happens, they then think we're going to sort of stabilize around the 2.5% growth rate, 2 to 2.5% growth rate we were getting before. And I think that's going to be a feature of most large Western modern economies moving forwards. Gone are the days of 3 to 4% target growth. More likely, we'll see 2.5% as considered a good growth number. All right. So this is something that we actually got from the US Federal Reserve earlier this week. And basically, this shows you where the US Federal Reserve members think interest rates are going in the next few years. So this is the trajectory of US interest rate rises as the Federal Reserve members see it. What they're saying here is that they think next year, the majority of them believe US interest rates are going to rise to 0.75%. Uh, that means that there's going to be 3 interest rate rises next year, according to most members of the US Federal Reserve. That will then rise, into 2023 to about 1.5% on average, which is another 3 rises. And then, 2024, looking at close to 2.5%, and then 2024 onwards, holding around 2.5%. Like I said before, the US bond market is taking a view similar to that of, the Federal Reserve. They're going to maybe need to spike rates for the next few years if inflation really is a problem, but then things are going to stabilize and moderate. I'd be very surprised if they even actually did get to 2.5%. But this basically says to us that, this might only be a few year thing where we see the tightening of monetary policy before monetary policy becomes, either flat or expansionary again. And I think, if you actually look at most nations over the past sort of 25 years, most of the time monetary policy has been expansionary rather than contractionary. And you only get short periods, perhaps like we're going to see in the next few years, where you have contractionary policy. All right. This is similar to what we're seeing in most Western nations. This is the US forecasts. Canada and the UK, here in Australia, New Zealand and Japan, and essentially they're all saying a very similar thing. Lifts for the next couple of years before rates sort of stabilize or perhaps even come down a little bit. So do keep that in mind. All this talk of monetary policy tightening, It could only be a very short run thing for a couple of years' time, if that, if that. So let's look at the different sectors. What's done well this year? What could do well next year? Well, if you look at the year-to-date performance, the strongest sector in the US has been energy, which is oil and gas stocks. And, basically that's because prices have recovered. We looked at the inflation data. We saw that oil prices had basically rallied quite heavily off their lows. Oil was really weak. Oil shares were really weak 12 months ago. Prices have bounced back extremely strongly there. That's just a factor of the world getting back on track. But if you actually look at some of the other stocks that have done quite well, they're not what you might expect. Financials have outperformed technology stocks this year to date in the US. Now, why might that be? Well, we said that this is a period where we're going to see some monetary policy tightening. Moving forwards, we're expecting slightly higher interest rates. Financials are, by and large, low-priced stocks that pay relatively high dividend yields. If you compare that to technology stocks, they tend to be much more expensive and they tend to pay very low dividend yields. Those expensive stocks on low yields are very unattractive when interest rates are higher because you're essentially giving up much greater opportunity cost. You can take a 2.5% risk-free rate from the US government. Why would you invest in, a very, very low return share? So a stock like a financial stock that might yield 5%, suddenly that yield is a lot more attractive at a higher, official interest rate or a higher risk-free rate. So financials have actually been one of the stronger performing sectors, but I think you'll find that generally if a stock is trading on a low multiple of earnings, if it's trading at a high dividend yield, if it fits the traditional value profile, it's likely to do well in the period ahead. It's likely to start doing extremely well. If we look at our own market, the performance has been a bit all over the place. Communications has been our strongest sector. That's because Telstra has rallied. So there's been a rally in Telstra that pushes our communication sector higher. Consumer discretionary has done quite well because they've levered into the online trading quite well here in Australia. But if you look, financials have also held up quite well. And again, like I said before, it's a factor of things moving forwards that are trading at low PE ratios, low price to earnings ratios, that are trading at high dividend yields are likely to perform extremely well. This is something that we're keeping an eye on moving into 2022 and something that we're targeting with our recommendations and the stocks that we suggest to clients. So what does all this add up to? Well, basically in the short term, this is a cyclically bullish period. For the next few months, late December, throughout January, February, and sometimes a little bit onwards, we traditionally see share prices rally. This is often a good time to be invested in markets. Now, we also have seen that markets have perhaps gotten a bit ahead of themselves with the inflation story. So markets have perhaps overbought that inflation story, and in the short term, you're going to get a bit of a pullback from the inflation story. We're already witnessing that happen in bond markets, and so we've seen those Australian and US government bond yield curves start to come back off a little bit, and that's even with monetary policy starting to be tightened. Markets have gotten a bit overbought on the inflation story. Um, Now, just in the short term, that means that some of those higher value stocks, those tech stocks, those really high valuation, high PE ratio, low yield stocks could have a strong period for just the next couple of months. And this is actually something that we tapped into with one of our most recent US recommendations, where we basically suggested a US technology stock called Take-Two Interactive. It's actually a video game company for those that don't know. Really, really strong fundamentals, and it had come off an awful lot over the past few months because everyone was jumping on the bandwagon that we're going to see rate rises, high value tech stocks, high growth stocks aren't worth it anymore, and it got oversold. So in the short term, we actually focused on one of those high growth stocks, and we'll be looking to hopefully take a profit in the coming period, this cyclically bullish period. What about the rest of 2022 though? That's only a slight over movement by the market that we're probably going to, witness pullback in the next couple of months. So what about the rest of 2022? Well, there's a lot of themes that we have to look at when deciding what to do. We know that the net government spending is starting to stall. So the huge government money pumps into the economy are starting to stall. We're seeing that here in Australia. The deficit is going to narrow, not by an awful lot, but it will narrow. In the US, the deficit is going to supposedly narrow as well. And that's going to essentially reduce the amount of capital support to economies. It's likely that we'll therefore see economic growth stall a bit in 2022. It's going to grow strongly, but that's where it'll sort of peak and perhaps turn around. Our own RBA is expecting 5% growth in 2022, but they expect growth to start coming off after that. With this and with the tightening of monetary policy, we think there will be a shift back towards value stocks. So a shift back towards stocks that trade on low price to earnings ratios, a shift back to stocks that trade on, higher dividend yields, a shift back to more valuable stocks or more fairly priced stocks. It's not going to be a period where everything does extremely well. I don't think we're about to move into a time where all stocks outperform. All stocks do extremely well when monetary policy is extremely expansionary, when there's huge amounts of stimulus being pumped in. All stocks do extremely well in FY 2021 and FY early 21-22, but not all stocks might do well after that. So we're returning to more value-based stocks, and we also like a return to more thematic investing. Here in Australia, we actually like base metals moving forwards, especially those that will be needed in green technology. Things like electric vehicles, renewable energy generating infrastructure like windmills and solar photovoltaic cells, but only if they're good value. We're steering clear of a lot of overvalued themes. So things like some things in the nickel space, some things in the lithium space are extremely overpriced. Whereas there's going to be more growth in things like aluminium and copper, in the coming period, and yet there's a lot of attractive stocks there in those spaces that aren't particularly expensive. So I'm just going to touch on one of the things that we're looking at to soon put a recommendation out on, and that's Sandfire Resources. Sandfire Resources, for those who don't know, is a company that's been built around their DeGrussa mine in Western Australia. And really the mine there, the DeGrussa operation, has been one of the greatest mines, greatest Australian copper mines that we've seen. The real sort of, I guess, negative thing about DeGrussa was its relatively short mine life. And so in the next sort of year, we're expecting all the copper sort of, or the last of the copper to be dug up from that site. This caused a bit of selling in the stock. It was coming to the end of its mine life, and everyone was like, well, no longer an attractive company. But since then, they've actually gone and purchased the Matsar complex in Spain. And after doing our analysis on it, we think they've paid a really fantastic price to acquire that asset. And it is going to be one of the lowest quartile copper producing sites on Earth. It's going to add another, 10 to 20, 10 to 12 years of operations to Sandfire. And that gives them time to develop their other projects. So they've got the Chukudu project in the Kalahari copper belt in Botswana, and they've also got the Black Buck project in Montana in the US. We think it's extremely attractive at the current levels, but they did just raise capital to buy that project, to buy the Matsa project at $5.40 a share. Currently, it's about $6.40, and we're not in the business of overpaying for stock. We're just going to see how things pan out a bit from here. Hopefully, it comes off a bit more. We'll get in at a good price, or hopefully we see a bit more positive data and we can get in at the current price. But Sandfire is perhaps the one that most closely fits the bill of things that we're looking at in 2022, and it is one that we will soon look to put a recommendation out on should our parameters be met. All right, guys, that's it for my section of the webcast, what I'm looking at in 2022. To reiterate, we're expecting a bit of a pullback in the inflation story in the coming months, And then going into next year, we think the shift is going to be back towards value. We like value in the base metal space. I'm going to pass it back to Tim now. But yeah, thanks once again for listening to that. And if you have any questions, do put them in the Q and answer box.
Fantastic. Thank you very much, Sam. Just bear with me. I'm just going to share my screen again. Okay, perfect. So you should be able to see my screen now. So there's a few little snippets there of what Sam said, and whether you picked that up perfectly or not, uh, I'll just repeat something, and I think it's really important. Two things. One, um, throughout the last couple of years after the big pullback from COVID, uh, you could almost go into the market, buy 10 random stocks, and you would have done extremely well on the recovery, right? Um, a lot of people did very well out of the markets in the last 2 years, and it was easy. Okay, a big roaring recovery like that, things are easy. But next year, things you got to start being a little bit more selective, right? So you got to start changing your headspace towards the markets and go, okay, well, I'm going to start being an analyst now. I need to actually start paying attention to what the themes are of the market, what's likely to outperform, and sell the things that are a bit overdone and get into what you believe is going to move next. Now, what we believe is going to outperform next year, as Sam said, is high dividend yielding stocks that have a low PE ratio, right? Value style investing will start outperforming. Miners, okay, should start outperforming. Um, so now we're more than ever working hard, guys. Okay, we're sifting, and we're trying to find stocks that are performing extremely well, likely to continue to perform well, but buy them at the right time. Okay, and I guess that's probably where we differ from a lot of other equity services out there. That you sign up to any other trading platform, you're going to get data. Okay. And within that data, you're going to get analyst expectations, you're going to get price targets. We're talking the Morning Stars, the UBSs of the world, those big analyst firms. The big difference between us and them is we don't put recommendations on every single stock. Okay. What we do is we put our recommendations out and time them to when we personally would buy that stock. And most of the times we are, right? 90% of the times we are buying that stock at that point of time ourselves, right? Or someone in the business would be, right? So, you know, we're only putting things out as for retail investors to say, hey, we believe this is now the time to buy this stock. These are the reasons. Okay. So, what I want to show you is how we do that. Right. And before I go any further, please, if you have any questions, don't hesitate to put them into the chat box now. The screen has changed over. Anthony, I'm sorry if you don't see my screen. I'm pretty sure, yeah, it's all sharing okay. Once again, this happens sometimes when we switch between person to person, and I apologize. I've got to contact the webcast provider, the software provider here, but just jump straight back in, and it should fix the issue. So basically, I want to just show you through a few things, right? First things first is our recommendation service. Okay. So what we do here, guys, is these are two of, or for one, what you're seeing in front of you is two trades we've already closed off in the US. Okay. And both of them we did not hold for a very long period of time. Okay, so Victory Capital, which is one we're still looking at getting back into now. We're in and out of that within 2 months and took 11%. AMD, okay, we got in and out of that pretty quickly as well. But our most recent recommendation that we've put out is called Take Two, and Sam did mention this earlier. They produce video games. Okay, they develop video games. For some of you that are into gaming, maybe on the webcast tonight. They make familiar labels like Grand Theft Auto, Red Dead Redemption. Okay, they're big names, huge names. Okay, um, but we went into these guys not because they're a value stock that pay a dividend. Even though that's our theme for next year, we're still buying into companies like this because yes, this is a growth stock, but it's likely to continue to outperform in the next 2 or 3 years, even without COVID. Even without all that extra Federal Reserve spending, these guys are going to produce 62 games by the end of 2024, a physical year 2024. 62 games, right, is what they're planning moving forward. Gaming doesn't go out of fashion, whether you're locked down or not, right? Gaming has had consistent growth out there. They're also moving towards what they call a metaverse style of gaming as well, which is something new that's coming out. So there's various different reasons outside of our quantitative scoring that we look at before we put a recommendation out. Okay, so we've got to believe in the company, we've got to believe what they're doing, and we've got to believe in the space that they can continue to grow no matter what happens economically in the years ahead. Okay, and then there's always the technical view and timing and that side of things that we use as well. But this would be a typical trade that we would send out, guys. Okay, so we're going to tell you what the company does. We're going to tell you why. Okay, we're thinking of getting in. We're going to talk about our quantitative scoring. So you can see here the overall score at the time for this stock was only 70. Okay, we're not always looking at it from 100, the highest scoring stocks on our quantitative scoring. Okay, sometimes something that scores around 80 is actually best because they might have had a bad couple of quarters. They've been been hammered down a bit too much on the market, and they're nice and cheap, and it's a good time to buy, right? So we give our reasons why, we give our buying range, what types of levels we suggest you to start buying in at, and where we think the share price is going to go. You can also download our full research data report here. If you write into your fundamentals, this will give you all your forward data. Oops. So we'll have our scoring on there, and then you've got all your financial data, forward data, and the rest of it. Okay, so it's fairly comprehensive. You can go as simple or as complicated as you like, right? So we've tailored this for both sort of more beginner investors that just want a simple explanation and just follow what we're doing, or if you are a seasoned investor and you want to know the detail, all the details here. It's all delivered in one package. Just click a link, jump into this page, and have a good little read, make a decision, and move on. Right. So that's how we deliver our recommendations. It's we're very selective, guys. Okay. We're not going to put a recommendation out on 500 stocks. Our goal is to maybe put two trades out a fortnight. Okay, on this. Um, we don't we want to be selective. We want to outperform. That's what we're aiming for. So with this service, what you're going to find is you can be a little bit selective within us being a little bit selective, right? Because some of these recommendations will hold for a couple of months. Some of them we might hold for 10 years, right? Um, it really ranges. Okay. So these are our open Aussie recommendations at the moment. And we've got some closed ones down here as well. So you can see from what we've closed so far. So we have done Sandfire once before. Okay. And we've picked up 31%, including divs. And, we've had a pretty good period through 2020, 2021. We can see here there's some long-term holds. Okay, Fortescue we've held right the way through, mainly for this reason here. Even though the share price pulled back dramatically, we're up 56%, including divs. This has to be for us. This is definitely one of the longer term holders, right? The divs just way too attractive not to be holding this stock. Wally, we've been in for there for a while. Healthy is definitely one of the ones that we were very excited about and has paid off the best. It's still going, right? So look, we've had a pretty good run through here. Yes, we have our losses, guys. Okay, especially with some of these smaller caps like Novarti. All right, so we're up on the first round of recommendations on that. We're down on the second round, but we still have very strong faith in this stock, and that's why we haven't closed out yet. We know Novarti very, very well. And if they do pull off their banking license, well, this stock could be an over a $1 stock, right? There's a reason behind every single one of these recommendations. A lot of research has gone into it. And, as we go, sort of our strike rate is definitely pretty damn good if you have a look at what's closed through here. And as all investors and traders, there's going to be the good ones, and there's going to be the ones that fall a little bit before we get a chance to make some money out of them, right? So I think we've done pretty well here, guys. Okay, in the way of Australian. Okay, if I flick back to US, all right, we've got Facebook in there at the moment, Goldman Sachs, and and the most recent there as well. So a little bit of a pullback in the market, but the rally up into Christmas will bring most of these likely back into the green again. Okay, so just that's our methodology, guys. Okay, that's how we look at it. Like I said, we're very different to a lot of the others out there. Now, the other part of the service is a lot of fundamental analysis here in our scoring. So, what I want to do is just quickly show you a demonstration of how we utilize our scoring to find ideas. Okay, so this is our Emerald Score screener. All right. And that gives us a score across about six odd thousand of the largest stocks in the US. So we're not covering off all the micro cap type stocks over there. About 6,000 stocks that we're covering with our scoring here. So, what we start doing, guys, there's a few ways you can go about it, right? But we're starting off looking at the highest scoring stocks. Okay, so these are the good all rounders. Okay, it means that they've got a good dividend score. They've got good growth and earnings scores. This is scoring across everything. Now, if you just want to look at what the best growth stocks are, well, you just filter by growth. Okay, and then you go, okay, what's the most, what stocks have had good growth so far that have really good forward estimates. Okay, so you got General Mills here, which is in the food industry, large cap stock in the US. Okay, so then from there, what you can easily do is click on the stock code, and it's going to open up the fundamental analysis for that particular stock. You have a read about what they do. You can see that they're in the top 500. Okay, they rank 489 from market capitalization point of view. And we can come down and have a look at how the scoring's been recently. So over the last 3 months, it's been pretty close to 100%. Okay, and you can see here that pretty much this has stayed fairly high from a scoring point of view, sitting anywhere around that 90 to 100%, and the share price has eventually rocketed up. So that's showing a chart of historically what the scoring has done versus share price movement. It's got a target of 65, and then you can flick over and start drilling down a bit deeper. Okay, PE ratio of 16. If you're into this sort of stuff, it depends on how deep you want to go, right? That's what it comes down to with this platform. You can sit on this page and look at basically this, and this tells you the story of what's happening here anyway, right? Then we've got a bit of sector analysis where we start comparing the stock versus its market cap. So anything with a market cap above 10, and so on and so forth. So yeah, got a bit of sector analysis there as well. I'm not going to go into everything here. You got the full balance sheet. We got dividends, so you can see the historical dividends, dividend yield. Okay, so this is not bad. Earning 3.5% yield on average. Okay, they've maintained that fairly well over the last 5 years on that average, and that's not bad for a stock that's got 16 PE and some potential forward growth. Okay. All right, so I'm not going to go into too much detail there. What you'd be doing from here, guys, okay, is coming across to our trading platform. Sorry, give me a second. Okay, so what we're using here is we basically white labeled Interactive Brokers, if you know who they are. They're a massive US firm. Okay, they're a listed company, and we're using their platform and reselling it out. So basically, they're a custodial structure. All US trading is custodial, guys. Believe it or not, most people aren't really aware of this. Whether you're trading through a HIN here in Australia, all HIN providers in Australia that offer US as well, the US component is custodial. Okay, there is no HIN for US. okay, here in Australia. It is all custodial. Um, Nonetheless, okay, we're extremely competitive in price. That comes with three platforms. You got this platform here, which is the downloadable one. This is the Trader Workstation. This is as good as a full service providers platform, right? So this is got as much data and flexibility as my iris screen. Uh, Applies your iris screen. It's very, very powerful stuff. It can be, but it also can be as simple or as complicated as you make it. Okay, I've got layouts that you can download off our website, and that way, you can start off with a similar layout to what I've got in front of you here, which is basically a chart and a watch list. And that's mainly what you're going to be doing in here, because most of your research you'll be doing, you could be doing in the Emerald Equities subscription that I just showed you. So GIS is what we're looking at before. Okay, General Mills. Okay, what we're looking for. This is a worldwide platform, guys. So you do need to look for New York. You need to look for Australia if you're trading Australia. Some codes are used across various marketplaces. Just jump in and do your technical analysis, guys, for timing. Okay, so the scoring is going to tell you if the stock's performing well. Okay, um, from a fundamental stuff, just from a pure, quantitative point of view, as in the numbers, as in, previous growth, forward growth, dividend, the numbers is what those scorings give you, and then simply come in here and pick your timing. Okay, so I'm not going to talk too much about that. I just want to demonstrate how we use it. And one thing that I do on my watch list, guys, is throw in some labels. Okay, so what I do is I have my high scorers, right? And I start building out my list. Okay, then I might have down here interested. I start building out my list of stocks I'm interested in, like the ones that are starting to get close to their timing. That's right. For me, this has probably run a bit too hard. The timing would have been either on the breakout day here, we're a few days late, or back at the trend. Okay, so this is where you start getting organized. Okay, this is what the Trader Workstation is really good for. Is that this is the main one you have loaded on your home computer, and you can start building out your watch list. You've got a really good chart here that goes out pretty long periods of time. Okay, so you see it's pulled in more data. So that's the Trader Workstation side of it. Then you've got the client portal. Now, the client portal is really useful. It's just a web browser version. You can log in anywhere you are on any computer. You don't have to download anything, right? So that's going to show you your portfolio. This is okay for research and charting. You can do it on here. I find the Trader Workstation's better for me personally, but you'll work that out pretty quickly. So you've still got charting on here as well. Only difference with the charting on here, guys, it just doesn't go back quite as far. Okay, so this is going back to 2017. There's plenty of data. You can still do all your trend lines in your analysis here. So it's as simple as just you can pull up any overseas stock you want around the world. You obviously got to sign up to the permissioning in the back end, and we can show you and teach you how to do that. Apple here, it's as simple as going in and buying. The great thing about interactive brokers, they do pretty much everything I've wanted them to do. They've got, profit taking orders, stop losses. So if you want to put automatic orders in, which is very important for us in Australia, if you're trading overseas markets, you want to be able to put your orders to close in at the time of opening. That way, you don't have to stay up all night watching things, right? If the stock comes and triggers your stop loss, this is automatically going to place that order for you. If you want to set a profit taker order, you can do that, which is quite unique. Um, not many of the Aussie platforms will allow you to do this. So, you know, they offer these little sort of tools in the background that we can teach you how to use, that will help you trade the US markets a lot easier. Okay, so you got a choice of platforms here, guys. Just to quickly show you, this rounds off our service, right? So our service is to give you recommendations, to give you screeners and ideas and ways of filtering down the markets to find the best possible stocks to trade. We give you daily updates. You'll get 3 emails a day from us. One is a morning view, afternoon, and nightly view. Within those emails, you're going to get some hints and tips of what we're looking at right now, what sectors we think are better, what areas to look at, or value or growth and things like that. If you just follow us along, you'll get a feel for what areas to use, what things to use in your screeners to look for stocks, right? If you don't want to do all that work, you just follow the recommendation service. And then it's as simple as DIY, come in and do it yourself, right? So come in, search the stock, place the order. And the reason why you would consider doing that through us is we're very, very competitive in price. Okay. So if I go straight down to the US side, I'll go through that really quickly first because that's where things get pretty exciting. Okay. So basically, we're $2 minimum a trade, all right? $2 USD a trade. Okay. Or point basically half a cent per share. So in the US, if you actually go trade in the US properly, not through an Australia provider, if you were a US resident and you went over and traded in the US, more times than not, you're paying per share. Okay, that's the traditional way of things over there. So with a minimum, okay, so there's got to be a minimum there. So this example is based off JP Morgan at $147 per share. Okay. So if you were to go out and buy $1,000 worth of JP Morgan at $147 a share, it's going to cost you $2 USD with us. If you do that through ComSec, it's going to be 19.95, NAB trade 50, 14.95, ANZ 59, or South Wealth a flat rate of $9.50. But one thing that most people don't are not aware of is most of these companies, except for South Wealth, trade. They charge you an FX fee per trade. Okay, South Wealth will charge you on the money when you put it into the account. So if you go into their account AUD, transfer to USD, they charge you an FX fee at that point. Okay, so you'll only get charged the FX fee once. I'll talk to that a bit more in a moment. But with some of the other providers, you're going to get charged that FX fee every single trade. Okay, every single trade. So if you compare us to ComSec, NAB, or ANZ, we're going to be $2.94 AUD. ComSec's $33, NAB trades $28, and ANZ's $86. As you start getting up in trade size, we're $3.74 for a 5 grand trade, including FX. 71 ComSec, 67, and this is for DIY, by the way. Okay, so this means no service, you just log on and do it yourself. Then if you come down, we also offer advisor assisted. So what that means is if you can shoot me a text message, you can shoot me an email, not in text message, but on one of our message services, you can send us a message saying, place this order for me. I'll go into the platform and place the order. Okay, so that's what advisor assisted is. You can jump on the phone, just got to contact me, give me instruction, I'll go place it for you. Okay, it's really good for the beginner trader, someone that has never really used a platform before, someone that's really busy. Before I came into the business, I used full service a lot. Okay, I was running 2 shops, I was flat out busy all the time. Um, and I'll just jump on the phone. I'll do my analysis on my lunch break, jump on the phone in the afternoon, and the advisor can tell me, all right, what's it trading at right now? What does it look like? Have a 2 minute chat and quickly place the order, right? So we charge $30 for that, okay, or point zero, point, half a cent per share, whatever's greater. Even if you're doing a $50,000 trade on a JP Morgan, well, it's still only going to cost you $30, right? So, it's not like it's going to jump up a lot or anything like that. But we're very competitive against everybody else, right? So once again, South Wealth doesn't offer that; they're pure online, but we do. Okay, so $30 a trade for that. All right, so where does things get interesting, right? I'm sure some of you out there are probably thinking, oh, but there's free brokerage guys out there. Okay. Um, well, those free guys aren't as not necessarily as cheap as you think. Okay. So, I'm not going to name names or go down that path, but all right, all the main ones that I've looked at in Australia, and there might be one or two that might not do this, but I've looked at about five different providers, and they all charge a FX charge. Okay, so some of them charge per trade, and some of them charge when you put the money across the USD. Now, if you put $50,000 from Australian to USD at the exchange rate, and the exchange rate, right now it's probably about 7.1. Actually, it's changed a little bit. Okay, you're going to get 35,500 USD. Okay, at that exchange rate. What the FX charge is they take 60 bips, they call it, out of that. So this is the actual rate they're giving you. Have you ever changed cash on the street overseas somewhere, or even here in Australia? Okay, you're sitting on Elizabeth Street, you go down to one of the exchanges, and they've got all their exchange rates up on the board. Well, they're never going to be the amount that's the official exchange rate. Okay, that's the official exchange rate. That's what they'll give you. And when you start doing your maths, well, that's $300 the difference, guys. Okay. Now, you think about that for a second. Yes, you're paying free brokerage, but you're paying $300 just to get your cash over there. Now, if you ever think about that for a second, 300, and let's say your average trade with us costs you $3. Okay. Well, you're doing 100 trades before you even get to that. The benefit with us, guys, is you can move your money around without having to pay this every time. So let's say you put your funds across to USD, and all of a sudden the USD, the dollar's falling. Move it back to AUD. Yeah. And it won't cost you a single thing to do it other than maybe one or two bips, which is the spread. Okay. We only charge spread, guys. Okay. Which is not a charge. It's what you pay to the market. It's what you pay to the world. Right. All of a sudden, what you're doing is you're moving money around like a big institutional investor. That's what you're doing, guys, right? By doing this through here. You do not have to pay this retail 60 FX charge. Yeah. All right. We're not charging that, guys. We're trying to make it as easy as possible for our clients to do what they can to outperform the market. Okay, so if we become, if we're long USD, leave your money in USD, no problems at all. If you think you're long AUD though, why would you have your spare cash sitting over there? With all the other crowds, you're going to be paying $300 to move 50K around. With us, it's nothing. It is literally just the spread. All right. That's the key difference. Okay. You can see that through here. That's why we're so much cheaper than the competitors, guys, because we aren't charging on the FX. Now, for the Australian dollar trades, okay, there is cheaper out there than us, but we can't, obviously we can't go to $3 a trade. $6.60 minimum is still extremely cheap as things go out there, guys. You can see we're very competitive against the bigger players. We're very competitive against South Wealth. There's probably a few others out there that are cheaper than us, but they do not provide what we provide in the US markets, guys. Okay, they just don't. All right. Even from a full service point of view, equities only, we're very, very competitive. Okay. So look, that's our trading service, guys. So there's two parts of the service with Emerald. We've got our Emerald subscription, which gives you access to all of our recommendations, our analysis every day. We give you our screeners. You get access to all of our scoring. You also get access to Sam once a week on a Thursday at lunchtime for a 1 hour webcast. Okay, where he'll run through similar to what we've done tonight, right? And that's why we give you sample sizes of this. We'll give you our view of the world, we'll give you our view of the sectors, and we'll give you some ideas to do some trades or some investments if that's what you're into. So yeah, look, so there's two parts. They're not exclusive to each other. You can just come over and do some trading with us. Make use of our very competitive prices, or if you want a bit more of an intimate relationship, you can use the advisor assisted fees, and then we've got the recommendation service on the other side of things. So just so could be a rundown of what we do and what we are as well. With the platform, guys, it is worldwide. Okay, you can basically trade futures markets through that as well. The CFDs options all around the world. Okay, it's huge. Okay, there's plenty you can do on there. All right. So, is there any questions, guys, before I end the webcast. So, guys, if you do want to know a little bit more about what we do, there's two ways you can go about it. One, type into the chat box book. What I'll do is I'll get our one of our advisors to give you a call, just have a bit of a chat through, what we do, what might best suit you. Because there's more, there's heaps we do, guys. Right, from trading education courses through to what I've shown you tonight. So there's plenty on offer here. We also offer portfolio services as well. So if you want to really sort of have a bit more of a deeper chat about our services and what we do, just type book into the chat box. Otherwise, you can sign up online for an account at emeraldequities.com.au. Okay, you can also sign up for our subscription there. But like I said, we're pretty friendly people over here, guys. If you want to have a chat about anything, you can do that quite easily, just by giving us a ring. Okay, so I'll just jump over here.
Yep. We do just have a few questions coming in, Tim, so I'll try and touch on them. Yes, so we do most major markets around the world. We do futures markets as well, and through the platform you can trade cryptocurrency futures as well. So you can trade futures on Bitcoin, Ethereum, and I'm sure there may be other ones that come out or will come out in future. So yeah, not just US markets all over the world. Most financial markets around the world are available through our platform, including futures markets and including futures on cryptocurrencies. So thanks for that question.
Perfect. If there's any other questions, guys, please shoot them in now. Otherwise, I think we'll wrap things up. Alrighty. Thanks for listening in tonight, guys. Appreciate it. Like I said, reach out if you want to have a chat. Otherwise, have a very, very Merry Christmas and a great New Year. This will be our last webcast for the year. So watch out. Early next year, we will continue to do these on probably every about 3 weeks or so, where we'll do half an hour of bit of free education or bit of information on what's happening in the market and just show you through what we're up to as well. Alrighty. I will catch you all on the other side. Have a great Christmas. Bye for now.